Hello everybody and welcome to another episode of Quick History. Today we're going to take a look at the Wall Street crash, an event in October 1929 which would have a devastating impact on the German economy. As always, there's a free handout in the description below, and make sure you click on subscribe if you'd like to see more GCSE history based revision content. Let's get into the details. The Wall Street crash is something which happened thousands of miles away from Germany on the streets of New York City. However, it would be one of the defining events of the Weimar government and would be one of the causes for its eventual demise in 1933. America was booming in the 1920s, and American citizens had money to spare which they used to invest in businesses through stocks and shares. Businesses and the subsequent stocks and shares continued to increase in price, and American citizens began to make a great deal of money. For every dollar that was invested in the American economy in 1920, it was worth approximately $17 by 1929. Throughout the entire 1920s, businesses and stocks and shares were on a continual upward trend, and it would appear that there was no end in sight. Seeing the potential to make even more money, a number of Americans began to use credit from bank loans to buy stocks and shares. We call this buying on the margin. They therefore bought stocks and shares with money which they'd borrowed from a bank. They would take the profit and then pay back the loan in full. This was a clever idea, but also a very dangerous idea, because if the company and the stocks and shares became less valuable, then they would have to sell their shares at a loss and would still have to pay back the bank loan, possibly with even less money than they started with. In October 1929, the Wall Street crash occurred. The most simple explanation for why the Wall Street crash occurred is that people began to see that their stocks and shares began to decline slightly in value. As a result, they decided that they were going to sell their stocks and shares, take whatever profit they'd already earned, and move on. The problem was, everybody else had the same idea. Very shortly, thousands upon thousands of people were trying to sell their stocks and shares. With a vast increase in supply and demand dropping because nobody wanted to buy them, the price of the stocks and shares completely collapsed. This was bad for people who'd bought them with their disposable income, but this was absolutely terrifying for the people who'd bought them on the margin. They had to now pay back their bank loans, but they'd made no money from their stocks and shares. In fact, they'd probably lost money. So they had to pay back their bank loan and were also in debt as a result of the stocks and shares which they'd purchased. As the stocks and shares became completely worthless, so did the companies who issued them. As a result, thousands of businesses began to collapse, leaving millions of people unemployed. As we've seen previously, the German economy was reliant on US loans. With the US economy now struggling, there was a risk that the Dawes Plan and the United States loans would be recalled. Stresemann had identified that the German economy was like dancing on a volcano. In October 1929, with the Wall Street crash, the volcano erupted. Join me in the next video where we're going to see what were the consequences of the Wall Street crash and the Great Depression on Germany. I'll see you then.